Red, the color of love. But red, the color of your portfolio, maybe. But what went wrong? Something happened since September 2024. And what happened? What could lead to the change in situations is exactly what we're going to check in today's video. Hey folks, CA Rachana Ranade here, and I welcome you all to a very important video. Let me tell you in the beginning that this video is only for serious learners. I believe you are one of them, and that is why this video is for you. Everyone knows what happened in September 2024. Market was at an all-time high. Okay, have a look at this. Market was at an all-time high, but simultaneously, if you know, US dollar was kind of at its weakest if I'm considering a shorter time frame, and even US bond yields were kind of at a lowest point if I'm again considering a shorter time frame. Now, what happened in September 2024? That was the first time after a lot of years, I think 4 or 5 years, after which the US Fed started to announce rate cuts. The very first rate cut was announced in September 2024, which was by 50 basis points. Now, what started to happen because of this? Once the rate is cut, bond yields typically start to rise. Now, with increasing bond yields, FIIs started to sell Indian equity and started to pull that money out to their country. Okay. Now, what will this lead to? This will lead to they selling Indian equities, they getting rupees, they'll convert rupee into dollars. So basically, they will sell rupees, they'll convert that into dollars and take money home. Home is their home. USA, right? Now, did this happen once? Unfortunately, not. This continued from September 2024 to almost mid-Jan 25. So, in short, USA has had 3 rate cuts since then. Okay, like we had just the first rate cut right now, that only 25 basis points. Till now, US has cut rate by 100 basis points. So, I hope you have understood that one of the key triggers, I'm not saying the only trigger, but one of the key triggers why FII started to sell off was good yields, good expected yields in the future. And if that were to continue, if the yields were to increase, then there is a chance that the correction may continue in our markets. But the big question is, will Fed keep on decreasing their rates or not? Before we move on, let me tell you a very important thing. Market may go in the sideways or in the downward direction, but what you have to ensure is that your knowledge always goes in the upward direction. And for that, we have a lot of free lectures which are available on our website www.rachanaranade.com. What you have to do is just click on the stock market courses tab, click on the drop down for the category, choose free lectures, and what I would highly recommend is you enroll for this free lecture on fundamental analysis. In this lecture, you will learn about a different perspective on PE ratio. You'll also get to learn about inventory turnover ratio, debtors turnover ratio, and how to analyze the impact of such ratios on stock market price as well. If you are an absolute beginner, I would highly recommend you all to check out this free lecture on basics of stock market, and links of all these free lectures are available in the pinned comment and the description box below. The US Fed could do so if they feel that the economy is not doing that great, they need to increase the employment and all these things, right? But what is the actual scenario in the US right now? For that, have a look at this. Now, if you see here, you can very clearly see that overall they have good economic parameters. The employment numbers also seem to be good. And simultaneously, one problem is that the inflation is also at a higher side as compared to their target range. Considering all these points, there are great chances that the Fed may not reduce the Fed fund rate or may not reduce interest rates immediately. There are great chances that it will remain stable for a few more months. Now, what happens if the Fed fund rate or the interest rates remain stable? This will mean that ideally bond yields will also remain more or less stable, correct? Now, as an FII, as a foreign institutional investor, what will I say? As an FII, assume I'm from USA, I'm an institution from USA, I'm saying that, okay, in my country only, I'm getting stable yields on government bonds. Why would I want to go anywhere else? Unless I find that there are some emerging markets which are absolutely lucrative. Okay. And if I were to ask you which was the darling market for the FIIs until few months ago, it was absolutely India. Correct? India was one of the most lucrative emerging markets, but then what went wrong? What happened post September 2024 again? We did talk about 2-3 points, but now let's talk only from a domestic perspective. Okay, Do you feel that there were a lot of people who were talking about steep valuations even prior to September 2024? Answer is yes. But always remember, higher valuations are ignored when the earnings growth is good, okay, when the overall sentiment is positive. What started post September 24, basically when Q2 numbers came up, the earning numbers were not that great. There were some initial signs of slowdown, and even that got confirmed when Q3 numbers also came up, that yes, there is a clear sign of earnings slowing down and earnings are not as per the expectations. Now question could be, what are the general expectations from Indian companies? Typically earnings are expected to grow at 11 to 12% if the valuations are to be justified. But if I were to understand what is the YOY growth on a Q3 basis, Q3 YOY, then have a look at, we'll check it on screen now. Okay, have a look at this. Now let me take you to Nifty. By the way, I'm going to present this data for the very first time, right? So pay more attention to this. So I'm going to go to the constituents part. Scrolling here. Now, what can you see here? All these are the Nifty 50 companies, right? If I scroll down. Now, important is 1 and 2. Now, what is this about? Quarterly sales variance. So, this talks about a year-on-year quarterly sales growth. You can see it here. So, year-on-year quarterly sales growth. So, basically, it's Q3 FY25 versus Q3 FY24 sales variance. Okay. And here, if you see, quarterly profit variance. So basically YOY quarterly profit growth. In simple words, if I were to understand what do I mean by YOY quarterly profit growth, it means that as compared to the Q3 of the previous year, how much have I grown in this Q3 of current year? Okay. So instead of saying, okay, Reliance grew at 6.6% as a sales variance, or as in the in top line, profit grew at 7.38%. Instead of that, what we could do is we could directly take an average of this or a median. So for that, I'm just going to scroll down and down and down and down till we complete all the 50 companies at Hero MotoCorp, which is the last one here. And what year can you see here again? Quarterly sales variance. So in short, all these 50 companies, income median, you can see median of 50 companies, sales grew at only 8% right now. Q3 I'm talking about. And profits grew only at barely 6.5%. Is this number below the expectation? Answer is 100% yes. This is below expectation. Correct? Because like I told you, the expectation generally from Indian markets is 11 to 12% earning growth, and we barely grew at 6.5%. Is this going to be accepted? Absolutely not. And when such things come up, then valuation comes more into limelight. At this level of earnings, this sort of valuation cannot be justified, and that is the reason why the sentiment starts to weaken and market starts to correct. So am I saying that low growth rate is the only problem right now? No, that is the only problem that we discussed right now. Rupee coming under pressure is also a problem. US tariff, I'm sure you are reading in the news, that is also a problem. FII selling, that is also a problem. Now question is that, can we really tackle them? And what things can be done to tackle them is exactly what we're going to check out in the next section of the video. Now that we have discussed all these four problems, let's understand what can be done to tackle them, right? The very first one is about addressing the problem of growth. Now, for that, companies at their end, what can they do? Possibility number one, they can now start innovating new products. But you know, the R&D, innovation, and then sales is going to take a lot of time. That will be done simultaneously. Number two, they can come up with some offers. If you're talking about directly a B2C kind of a business, bring in more offers, attract more customers, increase their top line. That is also possible. So company will keep on doing their own strategies to boost the top line. But should government also intervene here? Answer is yes. And are they actually doing it right now? Answer is again yes. And for that, have a look at this. You can very clearly see that RBI has already announced and has already undertaken the open market operations. Currently, you can see already 40,000 crore worth open market operation has been done. If you don't understand what is this, what do we mean by government buying bonds or government selling bonds, in simple words, let's understand, they bring in more liquidity in the market, okay, through these open market operations that we are talking about right now. If more liquidity is pumped into the market, what will happen? Obviously, consumption will be boosted, not directly, indirectly though. And if consumption is boosted, that will lead to more demand, more increase in top line, ultimately increasing the bottom line. Number two, to increase the consumption, to boost to boost the consumption. Second thing that the government did recently, everyone knows about that, is the tax rate benefit that was given in the budget up to 12 lakh zero. Everyone knows about that. I already have done a video for that as well. I hope you have checked that out. So that was the second thing that the government has done. And the third thing is about lowering of repo rates. And again, I'm sure you also know about this. You can also see the article on the screen right now, wherein everyone knows 25 basis points rate cut has been already announced, and there might be few more rate cuts which are lined up as well. So with all these three things, which three things? Open market operation by RBI, tax rate cuts by the government, and also lowering of the repo rate by RBI. All these things will lead to an overall boost in the consumption, not immediately. That doesn't, it's not like a magic wand that right now interest rates are cut, immediately consumption will boost. No, typically it has been found in the past, it has been observed in the past that at least 2-3 rate cuts minimum have to take place so that the actual impact is visible. Okay, so going back to these 4 points now, can we tackle the low growth problem? Answer is yes. Simple. Let's go on to the second one, rupee coming under pressure. Can RBI directly stop it? Does RBI actively intervene every movement? Ideally, no. I One of my professors of economics, she had told me that typically the terminology which is used is snake in a tunnel. And what do we mean by that? So typically RBI doesn't intervene unless and until we are within a specific band. Okay, if rupee starts to depreciate heavily, RBI may intervene. If it's, and otherwise also, right, of course. So right now, is RBI intervening or not? Not sure. But if I were to understand, so they are not directly intervening right now. Currently what we understand is rupee is just falling because of multiple reasons, including FII selling a lot. So just to understand based on technical analysis, everyone knows that rupee is falling, but till where can it fall? Because right now, if you know, there are news which say that it can also go below, I mean, it can go beyond 90 as well. Now, for that, what we'll do is have a look at this. Now, if you see here, this is a long-term chart that I have drawn here just to save on some time. You can see if I were to check the inner lines. So I've joined this high, then this high, and then this high. So what happened is that the rupee was hitting these resistance lines. It broke out from here. It took a it took a support here, and now it is continuing its upward journey, right? But if I were to join one this high and then just take it upward, then this is a limit of 90. Okay, plus this is also a psychological barrier of 90. So I personally feel, based on technical analysis, rupee may not slide below, I mean beyond 90 very easily. Ideally it should find its range between 85 to 90 is what I understand. But could there be one more problematic situation here? Possibility is yes. And that is the third point. The third point is about US tariffs. Okay. What can be done is what we'll understand, but what is the situation first? Everyone knows US is imposing tariffs, is considering to impose tariffs basically right now, right? Now, if this is done, what countries like China do? See, if US imposes tariffs, then for a country like China who is exporting goods, their exports become expensive. And if and if they want to counter that, what China does is that they devalue their currency. We don't do it actively. Okay, China devalues its currency actively. If that is done, rupee will again follow suit. Rupee will again start sliding, and sliding, I mean, it will go beyond 90 also. So that is one problem, but I don't see this happening very easily. Why? Because even USA understands that if they are going to impose heavy tariffs, that will bring in more and more inflation in the US economy, and I don't think they would want to take inflation to such a level that could hurt their economy, right? So I believe they may not impose maddening tariffs. And plus, the friends are meeting in USA right now. So let's see what the upcoming meeting of Modi ji and Trump is. I mean, what are the outcomes of that? It'll be interesting to watch. So if they are able to, come to good terms on not increasing tariffs by a high point, it'll be definitely favorable for us. And now comes the last point, which is about FII selling. Okay, what about FII selling? What can be done to stop them? Let's imagine a scenario. Okay, let's imagine a scenario that Q4 numbers, the upcoming Q4 numbers, are a shade better as compared to Q2 and Q3. Q1 FY26 numbers are better than that. And here they go close to a 12% or 13% growth in EPS in the in the bottom line. If that be so, would FIs be happy? Yes, because the growth would be good. Here, what happens if I'm talking about valuations? Valuation has 2 points: PE, correct? Price, if that remains in the range of 22,000 to 23,000, then what will happen? Let's understand. The numerator for price will be stable or may go down a little bit. Simultaneously, EPS, the earnings, may increase, and this will result in overall valuations coming down. In addition to this, if rupee also stays between the range of 85 to 90, then what has happened? As I mentioned, valuations will be justified and currency would also have been stabilized. And in this case, if you ask me, will FIs return? Answer is yes. They can't stay away from the Indian markets forever. It is a matter of time. We have to show that we can grow. We will have to grow. And if that be so, then FIs will return and the bullish sentiment in the market will also return. Well, I hope you enjoyed today's video. Today's video is different because we did talk a lot about macroeconomics. Before you stop watching the video, wait. If you want me to do a separate video on what's wrong with mid caps and small caps, just write down mid and small caps in the comment section and I'll be more than happy to make a separate video on that. If you did like today's video, don't forget to smash the like button. Don't forget to share this video with your friends. I'll see you in the next one. Till then, take care. Jai Hind and bye-bye.